Hello, everyone, and welcome to another weekly summary for the Divergence University. My name is Jordan, and today I'm going to be talking about some of the interesting situations, at least according to our analysis, our methods of trading for the Divergence University, and basically divergence-based trades. So the previous week started and ended 19th up until 23rd, which gives 4, right? Last 4 in the table here. So let's start from the top. We're going to go over them quickly. And of course, at the end of the day, if you have questions about these 4 examples or any other divergence idea, divergence based setup, do not hesitate to contact us, guys. That's why we're here. So let's begin. Euro yen, the first one. Well, the very first thing which becomes pretty clear and obvious since we open the chart, of course, is immediately that we can see the price moving lower, right? We're in a predominantly bearish trend. So if we want to be buying, we want to have either a reversal or a continuation. And in this specific case, what we can see here is that we're finding a bullish divergence at some point. This bullish divergence, one leg divergence, was then turns into a bullish convergence. This is where we're breaking above this thing, pullbacks, and then we're looking at second wave up. Now, once that happened, the idea here is very simple. We know we have a level right here, and this entire zone is practically a level. And we know that there is no divergence in the MI. So basically, we would be expecting for the price to go ahead and create another high, which kind of fits for the resistance or the top of the zone right here. Now, the tricky part in this situation would be that if you go ahead and protect something more conservatively, right, like here, right, the stop loss moves lower, then if your trading is based on the risk reward ratio of 1 to 2, or you're simply looking for the swing, you're not going to get the same ratios, right? This is pretty much the idea here. And it's a part which might be tricky for some. For some, this might be too aggressive, and if that's the case, well, then simply don't trade it, right? These kind of moves, simply go ahead and skip them. So bullish hidden divergence, euro yen. Then we have Kiwi franc, which is basically a double bottom. And from this double bottom, of course, you can go ahead and check out how Kiwi franc was developing on the daily chart. We were looking at something like this on the daily chart, right? And then we got this right here, which was first bounce from the line, push up and then push down again for this bullish divergence to happen. Again, probably not the most conservative idea, but you have more or less the level which was holding, and now we're holding this level once again, second time. MA is still not pushing up, which is again bringing the risk up, increasing the risk. Only the histogram here is changing the direction and it's starting to push up. So that's pretty much the idea, right? We're looking for this thing to bounce to the upside. Now, in this specific case, since we have this daily consolidation channel or whatever, what we can do is extend the risk reward ratio. So you're buying at the bottom or near the bottom. If it works and you don't get kicked out, you might be taking partial at the first resistances. And then once the price continues in that same direction, you might be looking for the next targets, basically extended, right? And if your final risk reward is 1 to 7 or 1 to 6 or 1 to 5, that means you can very easily drop the risk. So usually if you go ahead and you use 1% risk per trade, in this specific case, because of the risk reward ratio, you can go ahead and use half of that or a third of that. So if it wins, you make the same amount of money that you usually do. If it loses, you barely feel it on your account. That's the power of risk reward, of course. Frankian, here the situation is kind of similar, but not exactly, because in this case, at least I personally would be looking at waves and levels. So what do we have here? This is a triple structure or 5-leg structure down. Depending on whether you're using cycles or LF waves, there might be some differences, but basically those are the waves, right? We're reaching a level here, attempt to go lower first time, rejected. Attempt to go lower second time, rejected. Look at the candle here, right? Divergence in place, so we're pretty much looking for bullish push up. The good part here is that the target in this case would be right at the breakout of this inner swing low, right? And basically that level. So we're going below that. Usually you want your target to be, if we're talking about highs, below the high, or if you're talking about lows, you want it to be below, sorry, above the low, not below it, because the price tends to react around these swings, and you don't want to be missing a profitable trade by just a few pips, right? That's the whole idea behind it. Frank and Door Frank. Now this is also based on waves and counts, but in general the idea here comes to one very simple thing. The price starts pushing up. Of course, we're looking at that. Then we have a double wave structure here. We're reaching a level. This level is being rejected by this massive candle to the downside. We have divergence on the MAs, on the histogram as well. The level is there, count fits. So basically the idea is that we would be expecting for this thing to continue lower. And I think, yeah, that's pretty much all since the last week, at least according to our ideas, of course, in the list that we're following. It makes sense that you might be finding other opportunities, of course. Again, that's just according to us. So that would be all for this week. Have a wonderful one, and I'll see you in the next video. Bye for now.